Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Mortgage-Backed Securities Explained, a guide for investors and finance enthusiasts. Buying a home or investing in the financial market? Chances are, mortgage-backed securities, MBS, impact you more than you realize. These investments bundle home loans into tradable assets, helping lenders free up cash and fuel the housing market. MBS play a major role in global finance, but understanding how they work can be tricky. This guide breaks it all down, so you'll know what they are and how they affect the economy and you. Understanding mortgage-backed securities. Mortgage-backed securities, or MBS, might sound complicated, but they're surprisingly straightforward once you break them down. Think of them as bundles of home loans packaged together and sold to investors. To understand their importance, it helps to know what they are and how they're structured. Definition of mortgage-backed securities. A mortgage-backed security is a financial product made up of home loans. Here's how it works. Lenders, like banks, approve mortgages for homeowners. Instead of waiting years to get their money back through monthly payments, these lenders sell the loans to institutions like Fannie Mae, Freddie Mac, or private companies. These institutions then group multiple mortgages into a single package, turning them into securities that can be bought and sold by investors. For investors, MBS offer an opportunity to earn from the interest homeowners pay on their mortgages. For lenders, this process recycles cash, letting them issue more home loans. Everyone wins. Lenders can keep funding new mortgages, and investors get access to a stream of income. Structure of MBS. The structure of a mortgage-backed security can be compared to a pyramid, with each layer serving a different purpose. Let's break it down. Mortgages. At the core of MBS are the individual home loans. These loans come with varying terms, interest rates, and risk levels. Tranches. The loans in an MBS are divided into tranches, which are like slices of the mortgage pool. These slices have different levels of risk and are ranked by priority. For example, the safest tranches get paid first, while riskier ones pay higher returns but come with more uncertainty. Investors. MBS are sold to a broad range of investors, from large institutions to everyday buyers. Each investor selects tranches based on their risk tolerance and income goals. This setup spreads out the risk. Even if some homeowners default on their mortgages, the overall impact on the MBS is limited. Tranches help balance safety and reward, giving investors options based on their financial goals. MBS act as a bridge between homeowners, lenders, and investors. They keep the housing market moving by providing liquidity and creating investment opportunities that tie directly to the health of the mortgage market. Types of mortgage-backed securities. Mortgage-backed securities aren't one size fits all. They come in different forms, each tailored to meet specific needs for investors. Depending on your investment style or risk tolerance, there's likely a type of MBS for you. Let's explore the most common ones, breaking them down into manageable bites. Pass-through securities. Pass-through securities are the simplest type of MBS. Here's how they work. Homeowners make their monthly mortgage payments. These payments, including both principal and interest, are passed through to investors, minus a small servicing fee. Think of it as pooling money from multiple borrowers into a single stream of income for investors. These securities don't prioritize payments into different risk levels. Everyone gets a proportional share based on their ownership. Pass-through securities are known for their simplicity and predictability. However, they're sensitive to prepayment risks. If homeowners refinance or pay off their loans early, the income stream shrinks, which can impact returns. Collateralized mortgage obligations, CMOS. Collateralized mortgage obligations, CMOS, take things up a notch with added structure and flexibility. Where pass-through securities treat all investors equally, CMOS divide the mortgage pool into tranches. Each tranche gets its own risk and return profile. Here's how CMOS are structured. Tranches rank by priority. Some tranches get paid first and are safer, while others offer higher returns but take on more risk. Customized payment schedules. Tranches are designed to align with specific maturity dates, making them appealing for investors with time-sensitive goals. CMOS are ideal for those looking for tailored investment opportunities. They let investors choose between safe, steady returns or higher risk, higher reward options. However, this complexity can make them harder to understand compared to simpler MBS types. Fully amortizing versus interest-only MBS. When it comes to payment styles, mortgage-backed securities can differ significantly. Two common types are fully amortizing and interest-only MBS. Here's how they stack up. Fully amortizing MBS. In a fully amortizing MBS, homeowners pay both principal and interest over the life of the loan. For investors, this means that their cash flow decreases slightly over time as the principal amount gets smaller. However, these securities provide consistent, long-term income with lower risk since the principal is steadily repaid. Interest-only MBS. Interest-only MBS are different. Borrowers only pay interest for a certain period, typically several years, before they begin repaying the principal. During the interest-only phase, investors receive higher yields. But here's the catch: when the principal payments kick in, cash flow drops. These securities can be more profitable in the short term but come with added risk if borrowers are unable to handle higher payments later. Which is better? It depends on your goals. If you want something reliable and steady, fully amortizing MBS might be your pick. But if you're eyeing higher returns and are okay with additional risk, you might lean toward interest-only options. These types of MBS offer variety, allowing investors to choose based on their strategy and comfort level. By understanding the nuances, you can make smarter decisions and align your investments with your financial goals. How mortgage-backed securities work. Mortgage-backed securities, MBS, play a key role in the housing market and the broader financial system. They transform home loans into investment products, offering a steady return for investors and providing liquidity for lenders. To understand this process, it's essential to look at how mortgages are originated, pooled, and supported by government entities. The mortgage origination process. The journey of an MBS begins with the creation of individual home loans. Here's how it works. Borrower applies for a mortgage. A homeowner approaches a bank, credit union, or mortgage lender to secure a loan. This loan has specific terms like interest rate, duration, and payment schedule. Lender approves the loan. After evaluating the borrower's creditworthiness, the lender agrees to provide the mortgage. At this point, the lender assumes the risk, meaning they're responsible if the borrower fails to repay. Loans are pooled together. Instead of holding onto these loans, lenders sell them to larger institutions, freeing up their capital to issue more mortgages. These institutions combine many loans, often from different lenders, into one large pool, standardizing them based on factors like credit quality and repayment terms. Once grouped, these loans are transformed into securities, ready to be sold to investors. These securities allow lenders to keep issuing new loans without tying up their funds for decades. Think of it like a recycling process. Lenders sell loans, fill their cash reserves, and then start the cycle again. For investors, the appeal of MBS lies in the reliable income stream generated by homeowners' monthly payments. Since the loans are pooled, risk is spread out, making the investment more stable. Role of government entities. Government-backed entities play a major role in the MBS market by ensuring stability and trust. Three key players, Fannie Mae, Freddie Mac, and Ginnie Mae, help standardize the system and reduce risk. Here's what each does. Fannie Mae, Federal National Mortgage Association. Fannie Mae buys mortgages from lenders, bundles them into securities, and sells them to investors. Their focus is on loans from mainstream lenders like banks and credit unions. By purchasing these loans, Fannie Mae ensures a steady flow of funds into the housing market. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.